If you like what you see, if I can please request you to subscribe to my channel. So what is the weighted average cost of capital? The weighted average cost of capital, or simply the WACC, is calculated by taking the average rate of all of a company's sources of funding. As we all know, capital is a coward. It is continually seeking safer havens. A lower WACC indicates a very healthy business. On the contrary, a higher WACC is a riskier business and needs to compensate investors with higher returns to offset volatility. You can think of a company's average after-tax cost of capital from all sources, namely common stock, preferred stock, bonds, and all other forms of debt. But how is WACC calculated? The WACC is calculated by determining the proportion of debt and equity financing that a company uses. It is calculated by multiplying the cost of each capital by its relevant weight and then adding those together. If a company is funded through one source, let's say equity, and if an investor expects 10% return on shares, then the cost of capital is simply the cost of equity, which is 10%. The same would be similar if the company is funded only by debt financing. If the company paid an average yield of 5%, its pre-tax cost of debt would be 5%. However, the reality is that a company uses both in different proportions, and so the WACC is basically the summation of the above two terms. Sounds very technical, but how do we actually understand it and use it? Calculating a WACC is useful for investors and company management. A lower WACC means less risk and makes it more likely for shareholders to invest since they have confidence in their returns. A lower WACC also means future cash flows are more valuable, leading to higher valuations. Different industries have different WACCs. Telecommunications, media, oil and gas have higher WACCs since they need higher investment to remain competitive, and therefore investors demand higher returns. Retail, transportation, leisure have lower WACCs due to their predictability and stability. But what are some real-world applications of WACC? The WACC can be used for several real-world purposes. Let's take an example of capital budgeting. If a project has an expected return of 15% and the company WACC is 12%, I can certainly say that the project is promising. Let's look at mergers and acquisitions. If company A, which is the larger company, has a WACC of 10%, acquires company B with a WACC of 12%, the deal will likely create value. And finally, dividends. A lower WACC indicates that a company can afford to pay higher dividends, which is attractive to income investors. So my question for the day is, what is a tariff and why are they so important?